Okay, good evening, everyone. We're going to go ahead and get started. Tonight, we're going to be talking about Chapter 8, which is long-term assets. In particular, we're going to be discussing depreciation. I need to check some settings here real quick, and then we'll get started. Okay, so we're talking about long-term assets. We're talking about assets that last longer than 1 year. We're talking now, as you can see from the slide, we call it property, plant, equipment, but but it can mean a lot more than that. We're talking about vehicles, machinery, buildings, copyrights, patents, minerals. These are all examples of long-term assets. And so we're going to be learning how to deal with these in not only in transactions, but how we're going to be dealing with them in doing adjusting entries at the end of the year as well. Now, you can see by the slide, we have 4 issues. First, we have to determine what the cost is. And the cost is everything that goes in to getting an asset ready to be placed into service. It's not always just what you paid for a vehicle. It might have additional costs built in, such as you might need to put shelving in it. You might need to put logos on it. All the costs that go into any piece of equipment, that all gets included in computing the cost. And that you're going to hear me refer to it from time to time. It's basis. It's the basis you have in it. I'll give you a real world example. When I was with a chain called Hungry Fisherman, we had decided to put an extra fryer or 2 in every one of our restaurants because of an expanded line. All we had was deep fryers because we were a fish house, and 95% of our food was fish, and that all was fried if it wasn't broiled. So we had to put in an extra deep fryer or 2, and these were very large units. Because the stores were built over wood, or we had to put in concrete slabs over the wood flooring to support the weight of these fryers. Well, that concrete slab got included with the cost. So did running a special 220 line from the power box to the cook's line. It required special connectors, special plugs that would plug into the 220 line. So you had a lot of other things going on than just buying a big deep fat fryer, having it delivered, dropped off, and plugging it in. There was other things in getting these units ready to be placed into service, and these all got included in the cost of the item. Next, we have to figure out how long is the life of the product. Okay, we're not going to go and depreciate an item in 1 year. We're going to spread out the depreciation over the life of whatever that piece of asset is. So if you go out and buy a delivery van, chances are you're going to depreciate that over 5 years. You may decide to do it for longer. The life is determined by you. And I'm thinking about how the IRS treats it. I'll get into that in a minute. But you're going to decide how long whatever this asset is going to last, and you're going to depreciate it accordingly. Okay. We're going to talk about accounting for subsequent expenditures. In other words, is it going to be a repair, or is it going to be capitalized? And whenever I say the word capitalized, that means it's going to be a separate listed item that's going to be depreciated over a different life. And then finally, we have to discuss what do we do when we dispose of the asset? We just don't throw it away. And something we're going to look at is what's going to be the salvage cost when we get rid of it, because we have to take that into account. We may go ahead and decide to scrap it. We may decide to just go ahead and sell it. It still might have life left in it for somebody else who's willing to pay a lot less, who might need that particular asset. So there's different things we can do when we actually go to dispose of these long-term assets. So as I pointed out earlier, there's a lot of things go into the acquisition cost, not just paying for the item you're buying. Okay. Anything related to putting that asset, and this is a key phrase, putting the asset in service. And I'll give you an example. You might go out and buy a fleet of vehicles like 4 delivery vans, and you might put 2 in service right away, and you might wait 6 to 8 months before you put the other 2 in service. Well, you're going to start depreciating those 2 you put in service right away. You're going to hold off on doing anything about the other 2 items sitting there waiting to be put into service. Okay, so that's the meaning of that phrase right there. And as I pointed out, whatever costs are needed to put that in service, that's going to be a part of your acquisition cost. Very important to keep in mind. So when we're talking about machinery and equipment, here's some examples of things that get added in besides the purchase price. You're going to have taxes, transportation, insurance, and then installation and assembly. Okay, these are all items that get included with the original cost of whatever asset that you're buying. In the case of a building, it's going to be, you're going to have not only the cost of construction, but there's title fees, brokerage fees, attorney fees, and taxes that all have to get factored in when you establish what the acquisition cost is of a building. You have land improvements such as parking lots, driveway fences, walkways, and lighting systems. All right. And you're going to have to determine what the useful life of these are. And again, these decisions are up to you. You know, usually they're based on reliable studies. So you can go to outside references. There's a ton of publications out there that discuss what the useful life of different items are used in different industries. And you can rely on that information to make a decision. You can also rely on the IRS. And what a lot of small businesses do, they're not sophisticated enough to keep a set of books according to GAAP and a set of books for tax law. So they just accept whatever the IRS says. And there's a publication that you can get that you can actually see what the life of different products are. So when we're talking about, let's see, well, this publication actually has a depreciable life of a Ferris wheel. It has the depreciable life of horses, beef cattle. Needless to say, it has the most common things like furniture, computers. Furniture is usually 7-year, computers usually 5-year, vehicles are usually 5-year. So you can find in this publication what you're allowed to do on your tax return. And that's what businesses go by when they're determining the useful life of products. So it's just a lot easier to have the same numbers in your books as the same numbers that go on your tax return. You don't have to redo everything April 15th. Land is a little bit different. Land you will carry it on the books at its acquisition cost, but we're not going to depreciate it. It's going to stay the same from the day you bought it until you sell it. So that's important. When we do a tax return and we add buildings that are attached to land, where they go out and they'll buy a building with land, we actually have to separate out the land when we list the building. Because usually when you buy a property with a building on it, you know, it's land and building combined. So we have to come up with some way of determining how to back out the land costs on that. The land still's carried on the books. It's just not depreciated every year like the building would be. By the way, commercial buildings are 39 years. Residential rental properties, 27.5 years. See, IRS has a life for everything. So in our example, our first example here, CarMax paid $90,000 cash to acquire a group of items consisting of land appraised at $40,000, a building appraised at $60,000. Okay. And we have to break out the $90,000 cost based on the appraised values. So as you can see, in these, we're going to take the appraised value, list them on our chart, add them together, it comes to $100,000. Then we're going to come up with a percentage for the building and the land. It just happens to be 60% of the cost is the building, 40% is the land. And then we're going to multiply 90,000, which is the total of the two combined that we actually paid for, and multiply times those percentages. So we're going to come up with the acquisition cost that's been apportioned at $54,000 for the building and $36,000 for the land. Okay. And you can see here how it's recorded as an asset. Now, there's different forms of depreciation. And again, the best way to think about depreciation is we've got to spread the cost of this item over its useful life. Okay. So, because, you know, we have to match our expenses with the revenue it produces. If you're buying a $40,000 van and writing it off in the first year, and that thing has a useful life of 5 years, you're not matching the cost of that van against 5 years of revenue, are you? So you have to spread it out over 5 years, and that's where depreciation comes into play. Depreciation is an expense. Okay, it's a non-cash expense, as a matter of fact. So when you buy that piece of equipment, when we write it off each year a little bit at a time until it goes down to zero or its salvage value, then that's going to be listed on the income statement as an expense. There's three factors that we have to take into account: the cost, the salvage value, and the useful life, as we've discussed. So first we have straight line depreciation. Well, we'll start there, and then we're going to do units of production and then the declining balance method. The straight line is just like it is. You're going to divide by the number of years, and that's how much you're going to write down every year. Units of production, it's based on the number of units that it will produce. And so in other words, if you produce 1,000 units at 25 cents a unit, then you multiply 1,000 times 25 cents, and that's going to be your depreciation for that year. And usually there are machine ratings. This units of production is mainly used with machinery, and there's a lot of published information that if you're in an industry, well, like I think our example in here is going to be a shoemaking machine or something like that. So there's a industry that makes shoes, and they rate these machines, and you can find it published. It's in Thomas's Register, where that machine will say how much, what the life of that machine will be based on number of shoes that it makes. Now, they're not 100% accurate. Some machines will go on forever. Some will be no good after 2 years. So, or 50% of the units of production. Yeah, but you have to do the best you can to go by the information that you have. So next we have it when we're determining the straight line method. Okay, we're going to take the cost minus the salvage value and divide it by the number of periods or years. And in our first example, we're going to take $10,000. That's the acquisition cost. We're going to subtract out the salvage value of $1,000. And then we're going to divide that by 5 years. And that gives us a depreciation of $1,800 per year. So on December 31st, when we go to take the depreciation on that item, we're going to debit depreciation expense, and we're going to credit accumulated depreciation machinery. Now, accumulated depreciation is a contra account to property, plant, and equipment. So, and the reason why we got to keep track of depreciation is we have to know whether or not we have a gain or a loss when we dispose of the item. Now, something you should picture is look at BMW. There's every one of those pieces of equipment in that plant is on a depreciation schedule, and they're tracking depreciation of each and every single item. And well, anything that lasts longer than a year. So, and if it wasn't for computers, just imagine the amount of work that would be involved with that process. So straight line, you're going to write it down every year. In our example, at the end of 5 years, you're going to have a book value of that particular piece of equipment of $1,000. Now you can keep it and keep using it. It won't depreciate anymore. You'll just carry it on the books at its salvage value of $1,000 past that point. This is what a straight line depreciation schedule looks like. You'll see in the first column, there's the depreciable cost. That's that basis I was telling you about. We can see that the straight line rate is 20%. So to determine that, we're going to take 100% divided by 5, which is the life of the depreciable item. If it was in fact 8 years, the depreciation rate would be 12.5%, and so on. But in our example, it's 20%. So we're going to multiply 20% times $9,000, and that gives us our depreciation expense of $1,800. Then finally, we're going to be keeping track of, by item, the accumulated depreciation of that item, again, until it gets down to its salvage value, which is $1,000. And if you look at the last 2 columns, you'll see how that plays out. Units of production is a bit more of a process. First thing you have to do, and like I said, you have to know what the total units of production are going to be. So you're going to take the original cost. The machine might be rated for, say, 200,000 units. So you're going to divide your cost minus the salvage value. That's all. That these first 2, that's important. Okay. So you're going to take the cost minus salvage, and then you're going to divide it by the total numbers of units. What's your depreciation expense each year? Well, you got to count the number of units that the machine made. Then you have to multiply it times whatever the depreciation per unit is, which we just calculated above. Okay. And then so we multiply depreciation per unit times the number of units we made that year, and that year only. And that gives us our depreciation expense. So in our example, we assume that the machine will produce 36,000 shoes. The depreciable cost, which is a cost minus salvage, is $9,000. So when we divide 9,000 by 36,000, that's 25 cents per unit. The depreciation expense is now calculated at the depreciation per unit of 25 cents times the number of units made during that first year, which is 7,000. And that gives us depreciation expense of $1,750. Now, looking at the schedule, you can see number of units is going to vary each year. There's variables in how much the machine will produce. Maybe the production line was shut down for a couple of weeks for maintenance. Maybe your help went on strike. These are different. These are why you're going to have different number of units in that first column there, as opposed to having the same number of units all the way down. Depreciation per unit doesn't change. You'll get to your, when you do your depreciation expense, when you get down to where your book value is $1,000, you will stop You will not go beyond that point, which means that's where your depreciation expense is going to stop. And as we can see, in 2025, there may have been more than 5,000 units produced, but we're not going to depreciate them because by doing 5,000, we're down to what our remaining depreciation dollars are in that final year. So the double declining balance method is quite a bit more complicated. You start off with the straight line, okay? You have to calculate straight line when you are determining what your double declining balance rate is. So the way to understand double declining balance is this. When you drive a car off the car lot, brand new car, just paid $40,000 for it, it's going to depreciate about 20%. The value of items go down quickly after the purchase was first made. So the double declining balance kind of reflects that. You're going to depreciate a lot in the first year, a good bit in the second, and not much in years 3, 4, and 5. Okay. So that's kind of what you have to picture in your brains going on here. So we first have to calculate the straight line rate. Straight line rate, the item's going to, however number of years you're going to use, and we're going to use the same amount in all these examples, is 5 years. 100 divided by 5 is 20%. So we're going to double that. We're going to double the straight line rate in determining how much depreciation to capture. So step 2, we take the straight line rate of 20%, multiply it times 2, and that gives us a 40% depreciation rate each year. Okay. Step 3, to calculate what the depreciation expense is, we're going to ignore, be careful with this. We're going to ignore salvage cost until the very last year. So we're going to start depreciating the full amount of the acquisition cost at $10,000. And so as you can see, we're going to multiply, and this is to calculate first year depreciation, 40% times $10,000, and that equals $4,000, and that's going to be our for year 1 for 2021 depreciation. Okay. Now, this is one of those charts that you're going to need to follow one step at a time when you get to homework problems. You can't rush this. You got to calculate it line by line. So in 2020, we bought the item, but we didn't place it in service until 2021. So in 2021, the beginning book value is $10,000. We multiply that times 40%, and that gives us a depreciation expense of $4,000 at the end of year 1. Okay. Then and again, the accumulated depreciation and book value are the same as what we did with the other two. We're going to keep track of those through the life of the product. In year 2, we're going to take the book value at the end of year 1. As you can see, it's $6,000. So we carry it over to column 1, multiply it times 40%. That gives us a depreciation expense of $2,400. We're going to add that to year 1 accumulated depreciation. Now it's up to $6,400 accumulated depreciation. And we're going to subtract the $2,400 from the $6,000. That gives us a book value of $3,600, which we'll put in the far right column. Going to carry that over to the first column in 2023 and start the process all over again. When you get to year 5, we're not going to go below $1,000. As you can see, the book value is $1,296. I don't think 40% of that would be a lot more than 296. So since you have $296 of depreciation left, that's where you're going to stop. And then you can see that at the end of that year, you're going to be carrying a book value of $1,000 and you fully depreciated the item. Okay. You can see in comparing the different depreciation methods, the end result's going to get you to the same place. All three are going to depreciate that piece of equipment down to $9,000. It says that the most common method used is straight line. That's probably because of the large amount of real estate that's owned, and when you have buildings, you have to use the straight line method. So that's probably more of a reflection of how much real estate companies own than anything else. As you can see, that when you're doing taxes, you're using a system called MAKERS, Modified Accelerated Cost Recovery System. It's pronounced MAKERS. And it's not acceptable for financial reporting because it doesn't really consider salvage value. Okay. You can build salvage value into it if you like when you're setting it up. But I will say this, that unless you're a big company and you can afford accountants, you're going to be using MAKERS for books and you're going to be using MAKERS for tax as well. It's just simpler to set up your books according to tax and not do something differently. Now, one of the things we're going to be doing is actually calculating what do you do in a partial year, okay? So in a partial year, you have to essentially just depreciate an item for the months that you've had it. So in year one, you bought a piece of equipment on October 1st. You're only going to capture 3 months of depreciation. So the formula is very easy. $10,000 minus 1,000 divided by 5 times 3 over 12, which is a quarter. And that will give you the depreciation you will have in that very first year. Remember, you can't start depreciating an item until you put it into service. Okay. It's very important. You can't claim depreciation for an entire year if you've only had the item for 3 months. And like some of the other partial year calculations that you've done and will be running into, be very careful to count the number of months correctly. Now, sometimes your depreciation estimates will change. Either you will decide that it's going to have a longer or shorter useful life, or salvage value may change. And a good example of salvage value changing is if you're basing your salvage value on the taking it to the metal recycler, well, those prices change. It's a commodity. There was a time when China was buying up all the steel, and you could get 4 or 5 times the steel value of a piece of machinery than you could now. Now that's gone back down to the levels before the scarcity occurred on the market. That could change. Inflation could change your salvage value. Okay. Look at the value of used cars right now. Who would thought that automobiles in general would be scarce and we would be suffering the high prices that we're, so maybe if you valued your salvage value on your delivery van based on Kelley Blue Book, those numbers have changed. Kelley Blue Book's probably, if you go out 5 years, is giving you a much higher number now based on what used vehicles are selling for. So in our example here, we're going to look at the same machinery that we looked at previously. Okay. At the beginning of the third year, the machinery value was $6,400. Okay. And that's 10,000 minus the 3,600 in accumulated depreciation. And we're using straight line method. It's determined the machinery will have a remaining useful life of 4 years instead of just 3 or 2 rather. So, and the estimated salvage value will be revised downward from 1,000 to 400. So to make that adjustment in the year you're in, you're going to take the 6,400 remaining book value minus 400 in salvage value, divide it by 4, and that's going to give you $1,500 depreciation per year for the remainder of the life, which is the next 4 years. Now, an important decision point, and this kind of goes with IRS tax law here. This just all got revised by the IRS about 4 or 5 years ago. You have revenue expenditures and capital expenditures. Another way of looking at this is you have repairs, which is a revenue expenditure, and you have, I'm trying to think of another term other capital expenditures. You're going to have, it's going to lengthen the life, so it's going to be capitalized. That's the word I'm looking for. So you're going to either call it a repair or a capitalization. Capitalization means you're going to depreciate it over time. Real world example. When I was in the restaurant business, we used to get bonused off of hitting our minimal repair goals. We wanted to keep our expenses as low as possible. So if a refrigerator broke down, we would pray that the repairman would say we would need a new compressor, because if they just put Freon in it, that would bring it back up to its normal operating position, and that's considered a repair. But if they put a new compressor in it, that made it a capital expenditure. And that meant it didn't hit our P&L, and we wouldn't get hit on our bonus for that. Okay. So that's the difference. And right now there's a de minimis rule that the IRS follows. So if you buy something that you used to capitalize and have to depreciate it because it has a more than 1 year useful life, you can write it off as an expense if it's less than $2,500. You can go up to $5,000 if you have a CPA firm audit your books every year. So those are called the de minimis repair rules. But for our purposes, something is going to be a revenue expenditure or a repair if it just brings it back up to its normal operating position. All right. Some examples. If you have a jet plane, if you blow a tire on a jet plane, that's going to be a repair. But if you put a new engine on one of the wings, that's going to be a capital expenditure. If you have a fleet of delivery vans, your oil changes, your belt replacements, your tire replacements, all going to be repairs. But if you blow an engine or a transmission, or if it's an electric vehicle and you got to replace the battery, those are capital expenditures. Okay. Because spending that money on, even though they're technically repairs, I mean, you blow an engine, that's a repair, but you're making that particular asset last longer than it was designed to last. And that makes it a capital expenditure. Then you have to depreciate that engine over the life of the engine. And you'll keep depreciating the delivery van through its normal useful life. And you'll carry that engine as a separate asset until it gets depreciated out. We have people with rental homes that, they'll get a new air conditioning system, a new furnace, new hot water heater, and they have to capitalize those things. And so you'll have the actual rental home listed on the depreciation statement. Then you'll have 5 or 6 major things that were done, like a deck added, new roof, as I said, the air conditioning system, furnace, that kind of stuff. These will all be listed below the home that are going to be depreciated over 27 years. So, and I know you're thinking, well, you'd be lucky to get 5-6 years out of a heat pump, but unfortunately, the IRS rules say you got to depreciate it over the life of the building. And so the only good news there is if it goes out again, you get to write off everything in the year that you have to replace it. And this particular slide just describes what I just did: ordinary repairs versus betterments. That's the word I was looking for, and extraordinary repairs. So you have the expense, the revenue expenses, and then you have the capitalization of those other items. So this is how we set it up as a journal entry. You can see that your journal entry on the repairs is going to be a debit to repair expense, credit to cash. I have kind of a problem with, they should have reversed this. They should have made the repair $1,800 and the betterment $9,500. This is really backwards and wrong, but based on what I just got done telling you. But you can see that if it's a betterment, we're going to be debiting the long-term assets, in this case machinery, and crediting cash. So here's the issue. All right, when you get rid of a piece of equipment, it's never for exactly what salvage value is. You might not get anything for it. You might want to just haul it off to the dump. Or you might plan on selling it for, I don't know, $6 per 100 pounds at your local metal recycler, and they're only paying $5, or they're giving you $7, which means you're either going to have a loss or you're going to have a gain. Okay. So we're going to have to journalize the disposition of the asset, regardless of whether or not we get money for it. Okay. So if we have more cash, we get more cash for an item than what we carried as a book value, it's a gain. Yeah, we have shown a book value of $1,000 for salvage. We sell it for $2,000, we have $1,000 gain. If in fact we only get $500 when we take it to metal recycler, and we carry it on the books as $1,000, then we have a $500 loss. What are we going to do if we have a gain? Gain is revenue. Gains like sales. So we're going to record it as credit. And if we are recording, if we're recording receiving cash then less than its book value, then we're going to have a loss. If we get exactly what the salvage value is, we have no gain or no loss. We're just removing the equipment off the books. So in our example, a machine costed $9,000 with accumulated depreciation of $9,000 on December 31st, was discarded on June 5th. Okay. So we have zero salvage value when we depreciated it. So we're just going to do a debit to accumulated depreciation, because we got to wipe that off the books when we get rid of it, right? And then we got to wipe the machinery off. So we're going to credit the asset called machinery, and that takes it off the books. If in fact we have accumulated equipment cost $8,000, accumulated depreciation of $6,000, okay, and we discard it on July 1st, which is middle of the year. Well, it's a two-step process. First, we have to record the depreciation for the year, okay, because we discarded it halfway through the year. We still get depreciation on 6 months. So the depreciation happens to be $500. So we're going to debit depreciation expense $500, and then we're going to credit accumulated depreciation $500. Now we're ready to write that equipment off. So our accumulated depreciation, if you look at an example, it says $6,000, but it's really not. We just took another $500 off. So our accumulated depreciation total $6,500. We're going to debit that. because that we got to get rid of that balance now. We're getting rid of the equipment. We got to get rid of that accumulated depreciation equipment account. Next, we see that we're suffering a loss of $1,500 on disposing of the equipment. So that's going to be a debit. Then finally, we're going to credit equipment $8,000, which takes it off the book. Want to point something out here. Loss on disposal of equipment is the same as an expense. It costs us money. Whenever something costs us money, we got to look at it as an expense. That's why we are debiting the loss on disposal of equipment. Next example. BTO sells equipment that originally cost $16,000, has accumulated depreciation of $12,000. They use straight line depreciation at $4,000 a year. The equipment is sold for $3,000. So first we got to calculate the depreciation for the year because they got rid of it on March 31st, 3 months out of the year. To account for that, we're going to take the 4,000 year depreciation, multiply it by 3 over 12, which is 0.25. All right, that comes to $1,000. So we're going to debit depreciation expense 1,000, and we're going to credit accumulated depreciation 1,000. Next, we have to record the cash we received. So the cash we received is $3,000. The accumulated depreciation equipment is $13,000, which happens to match our book value. So, I mean, there's no gain or loss. And then we're going to credit equipment $16,000. No gain or loss. We don't have to record a gain or loss on the getting rid of this equipment. Now, if we sell above book value, and again, March 31st is, we're going to have to capture 3 months depreciation, which is the same as the last problem. So I won't go over that. So we record the sale of the asset. We're going to get $7,000 for it. Now, I'm trying to think of a quick, easy way. Well, you can see $7,000 cash that we receive minus the book value of $3,000, okay? Because we're in the last year. That's going to give us a $4,000 gain. So we're going to debit cash $7,000. We are going to credit accumulated depreciation equipment $13,000. Then we're going to credit gain on disposal of equipment $4,000, and we're going to credit equipment at $16,000. Check your work after you do this journal entry. Total your debits, total your credits, and make sure they equal each other, okay? Then finally, when we have a loss, which is below book value, in this case, we only got $2,500 for something we were carrying on the books at $3,000. So that means we had a $5,000 loss. I'm not going to go over again the first entry. It's the same as the other two. So if we take the 3,000 minus 2,500 cash, we got $500 loss. We have 3 debits here. $2,500 cash, $500 loss on disposal of equipment, $13,000 debit in accumulated depreciation, and then finally a credit to equipment of $16,000. Now, next we're going to talk about natural resources. And so when we deal with natural resources, it's similar to straight line depreciation. Actually, it's similar to units of production. So this is very, very similar when in calculating, because we're going to have to come up with the cost per unit in whatever that is. It might be by the ton, might be by the pound, just depends on the different mineral that we're talking about. So in our example, we had a mineral deposit with 250,000 tons of ore that we purchased for $500,000. No salvage values expected. We're going to get it all out of the ground. The depletion is what this is called. I couldn't remember. I was going up against a mental block. So this is what we term depletion. And so if we calculate that the depletion charge is $2 per ton, which is $500,000 divided by 250. If in the first year we mine 85,000 tons, the depletion charge is $170,000. Now, we have no salvage value, so we're going to ignore that. All right. So when we come up with a depletion expense, notice this is an expense. We're going to multiply the depletion per unit times the number of units extracted and sold in the period. Okay. All right. This is an example of what your journal entry is going to look like. It's pretty straightforward. You're going to debit depletion expense and you're going to credit accumulated depreciation. Give me a minute. I'm just going to be right back. I'm going to close the door. Okay. So if some ore remains unsold, all right, then you're going to carry that in ore inventory. So in this example, we can see that if you carry the depletion expense mineral deposit at whatever is extracted out of the ground, and then the balance is carried in ore inventory. And then you will credit the accumulated depletion of the mineral deposit, so that both sides of the balance, both sides, debits and credits equal each other. Now, this slide basically says if you need other assets to get the ore out of the ground, they're going to be depreciated just like what we saw, because they consist of machinery, buildings, vehicles, that sort of thing. So they're going to be handled separately. They don't get included with the extraction of minerals. So what are intangible assets? You use intangibles every day. You use software, you read books, you listen to music, copyrights, patents, licenses. These are all intangible assets. They get recorded at cost when you buy them. All right. And they have a limited or indefinite, they have either a limited or indefinite life, but in most cases, they have a limited life. So again, these are the examples that I gave you. I won't review the list. Some examples: patent owner has a right to manufacture, sell a patented item for 20 years. Copyright gives somebody the right to use their work for 70. Although I understand there's something in there that Disney helped create through our legislation that lets you renew that. And then you have franchise and licenses, which is the right to sell someone else's product. And just look at any fast food restaurant and you'll see that that's an example of a franchise. You have to pay for that and you get to amortize it over the life. And what we're talking about here is amortization. So these are all in your book, so I'm just going to skip through those quickly. Now we have something called asset turnover. That's going to be our formula of the week. You take your net sales divided by average total assets, and this gives you your total asset turnover. This is a measure of efficiency. Okay, as we can see, comparing Starbucks to Jack in the Box, we have a total asset turnover of 1.22 for Starbucks. And then we have a total asset turnover of 1.07 for Jack in the Box. And you can see that asset turnover got worse with Jack in the Box and seemed to improve with Starbucks over the last few years. And that's it. That's the end of the chapter. The last thing I want to, first, let me take any questions that you might have. If you have any questions, please come off mute. You have to take yourself off mute in order to ask a question. Okay, I don't see anybody asking any questions. Before we leave the session, this is mainly in addition to y'all, for the people that are going to be coming on and view this. We're not going to have a session next week because next week's the beginning of spring break. So our next live session will be 2 weeks from now. Oh, I need a phrase that I can use for the people watching the video. So what I would like to do is describe something about salvage value. So if you are watching this video later and doing the survey, well, you guys have to put it into just describe something about salvage value that we talked about earlier. Okay. And that's it. If you have any questions, feel free to email me. And if I don't get to talk to you before spring break, have a good, safe spring break. Talk to you all soon.